All right, good afternoon, everyone. On behalf of the National Glass Association, I'm Sarah Neiswanger, Associate Director of Industry Engagement, and I'm joined by my colleague Lori Cowan, who's editor of Window and Door magazine. And thank you for joining us for today's Thirsty Thursday webinar featuring Chris Beard of John Burns Research and Consulting. Before we begin, let's see what's happening around the NGA. NGA's third annual Glass and Glazing Advocacy Days is now less than 2 months away, taking place May 14th to 15th in Washington, D.C. For the folks in your company who are actively working on products impacting such things as sustainability, bird-friendly glazing, school security, and workforce training and development, those who are passionate and interested in meeting with the representatives of your state and those influencing these conversations on the floor, this event is for you. Take a look at the advocacy section of our website as well, where you'll find more information on our priority issues, legislation that has been impacted, and talking points. These can and should also be used at your state level and local jurisdictions to help shape any of your advocacy-directed conversations. The next event is the NGA Glass Conference Milwaukee. Being hosted August 6th to the 8th, please mark your calendars now for what will be a fun and educational event and will include a local facility tour. Registration will open at the end of April, so stay tuned for more over the coming weeks. I'm now pleased to introduce my colleague, Lori Cowan. As mentioned, Lori is editor of Window and Door magazine. She has 16 years experience in editing trade publications for the construction industry and has been with the NGA for the past 5 years. She'll tell you a bit more about what to expect with today's session. Lori?
Good afternoon, and thank you for participating in today's webinar. I'm Lori Cowan, editor of Window and Door magazine. I'm delighted to introduce Chris Beard, Director of Building Products Research at John Burns Research and Consulting, to present the latest results of the Window and Door Market Survey. The survey is the result of an exclusive partnership between Window and Door and John Burns, engages the pulse of the residential fenestration market. This first-of-its-kind index equips industry participants with valuable information about current and future business conditions. Today's presentation covers the results of our second quarterly survey. Window and Door is also accepting survey responses for our annual Top Manufacturers List and Report. The list details North America's largest manufacturers of windows, doors, skylights, and related products based on sales volume. The corresponding survey asks participants about product trends, sales, labor, challenges, opportunities, and more. The results will appear in the May-June issue of the magazine on windowanddoor.com and in Window and Door Weekly. We will put a link in the chat for more information and to fill out the survey. You can also reach out to me directly with any questions. Back to the topic of today's webinar, please join me in welcoming Chris. Chris, take it away.
Great, thank you. And it's a pleasure to be with everybody. I'm going to share my screen really quick and begin the presentation. So I think everybody can see that. And so what we're going to cover today are a few different topics. The first I'm going to go through is the macroeconomic backdrop for new construction and repair and remodel, and how it really impacts the window and door industry. So all the content today is obviously going to be focused on the window and door industry. Then, as promised, I'm going to present some insights from the latest Window and Door Market Survey. These are the fourth quarter 2023 results of the survey that we surveyed manufacturers, glass shops, glaziers, and also some larger installers. And then finally, we'll wrap up with some takeaways, and there should be some time for some Q&A afterwards. So let's start off with the macroeconomic backdrop. First, we'd like to say is spring is off to an early start for housing and the economy. And that's really driven by a few different things. Number one, the labor market is normalizing, but remains relatively strong. It's also fueled by immigration. We recently published our first ever demographics report, and we found that in 2023, the US population grew by a whopping 3.8 million residents. This is the largest one-year population increase in history. Job quits are back to pre-pandemic levels, but are still high relative to history. And that's important because that's a sign of a healthy economy. When job quits are elevated, that means that people are secure in their jobs and they're looking for new opportunities. The rate cuts are still coming. They're still coming this year, as we heard from the Fed chair yesterday. The rate cuts are coming later than expected. The market was planning for rate cuts to come earlier this year. Some were actually thinking it was going to come in March, and as we found yesterday, they did not happen. And for right now, the Fed's sticking to their word about these cuts coming later in the year rather than sooner, but they are still penciling in 3 rate cuts for this year, which is going to be have a positive impact on housing and the overall economy. And consumer optimism continues to rise. Consumer sentiment data is rising quickly and is now higher than any time since the summer of 2021. Context there is important because if we think back to the summer of 2021, rates were still at 0% and stimulus money was still flowing from COVID. So the consumer sentiment being higher now at these levels is definitely a positive move for the economy. We also saw the leading economic index this morning shows the first positive month-over-month change in 23 months. This broke the second longest losing streak of negative data going back to 1985. So overall, the economy is picking up signs of increased optimism. Builders are capitalizing on this rising consumer confidence and continue to take share from the resale market. The resale market is still very soft, and this morning we did see existing home sales rise year over year for the second straight month, but still at very low levels. Per our survey work, and we'll go into this in a minute, 87% of builders are using rate buydowns to get mortgage rates below 6%, which is really driving new home construction. And then we're also seeing a positive sentiment in the remodeling industry. Remodeling professionals are seeing increase in inquiries. Remodeling demand is showing a modest improvement in the fourth quarter, and we're seeing it earlier this year. And they're increasingly optimistic about seeing a rebound in remodeling this year. High home equity levels and aging homes are contributing to positive demand for remodeling. So let's dig into these topics. First, net immigration surged to a record high 3.3 million in 2023. This is a historic influx of immigrants that's really expanding the U.S. labor supply. This comes from our demographics report that we recently released, and the data comes from the Congressional Budget Office. They record what their estimates were for immigration. We believe the CBO data is more accurate than the Census Bureau data. There's no clean data, but our tabulation of this estimates at about 3.3 million. We've talked a lot about labor shortages. We're going to talk about that again today too, and we see this as a positive boom for the labor supply. Job quits are falling from all-time highs, yet if we look back to the historical data back to 2001, they're still above historical norms. So why am I showing this? Number one, this is a sign of a healthy economy when job quits are still elevated. But number two, it's really important is because of this is exactly what the Fed wants to happen. They want to see these job quits to fall a little bit, meaning the labor market is cooling, which is another positive input for the Fed in their policy decisions on when they're going to implement rate cuts. We do still see some macro risk to the outlook in the broader economy, and it's really driven by a few different things. Number one, all eyes are going to be on the Fed because to achieve the Fed's mandate of 2% target inflation is going to be the most challenging. We still see elevated CPI data coming out, and that's what's leading to Fed pausing these rate cuts or delaying them into later this year. Another wild card is an election year. We're obviously in an election cycle here, and that's starting to pop in some of our surveys too. In the fourth quarter survey with the window and door industry, we did see some concern around election year, but our research has shown that that's not always the case. And a couple reasons for that. Number one, the election cycle never really ends. It seems like the traditional 4 to 6 month presidential election cycle, that's extended. It's extended pretty much the entire 4 years since 2020. And so we think that consumers are becoming more immune to this discussion and maybe in some instances a little bit callous towards it. And so we do see strong secular drivers pointing to strong remodeling and new construction spending. We're really watching the rapidly falling cyclical headwinds. So higher interest rates, supply chain issues, high inflation. We're seeing those wane, and we think that that's going to be, we're seeing a convergence towards a sustained period of growth. And that's reflected in the consumer sentiment that I mentioned earlier. And you can see the levels and how consumer sentiment from the University of Michigan Consumer Sentiment Survey is really showing an increase at levels higher than 2021 when interest rates were 0 and stimulus money was still flowing. Thinking about new construction, builders are taking share from the resale market, and new homes represent 14% of all sales. This is the highest level since 2008. So we think about all home transactions and those homes that are locked into low mortgage rates, people in existing homes not listing them for sale because they don't want to lose those low mortgage rates, sub 5% mortgage rates in many instances. So builders are able to offer incentives to get to lower market rates, driving up the share of new home sales to total transactions. This slide comes from our builders survey. So we survey approximately 20% of new home sales each month. And what we found in the fourth quarter was only 13% of builders were not offering incentives to drive new home sales. The most common item used is a rate buy down for the full term. So they're able to buy the rate down up to 250 basis points in some instances to get mortgage rates below 6%. This is really disproportionately helping entry-level buyers because the entry-level, the mortgage payment is calculated on the payment for the full term. This is really driving the sales of first-time and spec homes. And also our monthly survey of building materials dealers, which we just released this week, shows that building materials dealers are expecting the largest volume increases from production builders. Again, these are the builders that are able to offer these rate incentives and really driving new home construction. We're seeing this in the starts data that we get from our builders too. We calculate starts on a community count basis. We think that's a better measure because it takes the communities that builders have and the number of homes started per community. And we have data going back a very long time on this. And what we're seeing is that in February, builders averaged 3.2 single family starts per community. So think about like per subdivision in February. This is up 22% year over year, and it's well above the 2.7 February average from 2013 to 2019, which we attribute to more normal years. So leaving out the COVID boom from 2020 to 2022, the average between 2013 and 2019 was 2.7. So the starts are still well above those historical levels. And our building materials dealers are also noticing this uptick in starts and their total order growth. So we asked them each month about their total order growth, and you could see beginning in January of last year, orders turned negative. And since October of 2023, dealers finally turned the corner and we're showing year-over-year order growth. And over the past 3 months, this order growth is accelerating. This is really coming from that new home construction that they're seeing from production builders primarily. But on the remodeling side, professional remodelers are expecting higher remodeling activity in the near term, which is the next 3 months. This comes from our U.S. Remodeling Index, which we do in partnership with Qualified Remodeler Magazine. And this is a diffusion index, so anything above 50 indicates growth. 0 represents all professional remodelers are indicating weaker project activity. 100 means all of them are indicating stronger project activity. So you can see the near-term activity gauge, so activity over the next 3 months, the aggregate index comes in at 61, but we're seeing significant jump quarter over quarter. So the gray bars underneath each were the previous quarter. And we're seeing a significant uptick in demand from all different types, from full service remodelers to design build firms to home improvement pros. That's really driven by a few different things. Number one, homeowner equity has risen sharply since 2019. No secret, the home price appreciation due to strong demand and limited supply is driving up home prices, and that's untapped equity that homeowners have. Households staying in their homes longer have been beneficiaries of this real home price appreciation, and the equity per household is close to record highs, even adjusted for inflation. As interest rates ease, we anticipate households with this equity will be able to tap some of that home equity and use home equity lines of credit. And we think that they're going to take advantage of this lower cost of capital and lower interest rates to access this home equity to fund large remodeling projects. Another tailwind is 79% of households are locked in with rates below 5%. Obviously, there's some regional variation. This map outlines the percentage of homes that have current rates, outstanding mortgages below 5%. And you can see the red areas are higher areas of concentration of rates below 5%. So this is going to encourage remodeling versus moving. Even as interest rates come down, we do not anticipate over the next forecast period for mortgage interest rates to be below 5%. Not this year, not next year. So this is a powerful incentive for homeowners to stay locked in with their current sub 5% mortgage, because no matter where they move, if they move to a different home, they're going to have to get a reset on that interest rate. We also talk a lot about aging homes, and so we see this is a complicated chart, and we'll be sending out the deck, I think, after this too. But we did an analysis on the homes in the U.S., and so we did an overlay of aging homes, high concentration of older homes, and households with higher disposable income. And you can see some of these areas. The darker green, as we have in the arrow here, the dark green is the areas that we feel that should be targeted because it's a higher concentration of older homes in what we call prime remodeling years. So those homes that are between 20 and 39 years old that are ripe for replacement projects, including window replacement projects. So there are pockets of growth around the country for R&R contractors to be able to focus, and we think there's going to be high growth in these regions. Another thing that's driving it is we're seeing unprecedented wealth creation driving the U.S. housing market. And this, again, is from our recently released demographic survey. And we see people born before 1970 saw unprecedented net worth. They saw their net worth rise 24% to $107 trillion between the first quarter of 2020 and the third quarter of 2023. A lot of this is driven by real home price appreciation, so homes that are paid off and those home values have gone up, meaning that's part of their overall wealth. But also stock market, so investments, 401ks. The stock market has done incredibly well since that time. So we're seeing strong growth in net worth. What we're seeing is what we call the 1930s savers generation. So those born in the 30s, their net worth is shrinking due to deaths, later life expenses. But we're also seeing across all of these generations wealth transfer to some younger generations. So this intergenerational wealth transfer, this real wealth that these generations have, is getting transferred to younger generations with help to be able to help out with things like home purchases and other life events. So we think this is going to be a powerful tailwind for the industry as well. And then remote and hybrid work also allow commuters to move farther away from office, where homes are more affordable, and builders can also more easily buy land where there is land availability. There's been a lot of talk in the headlines about companies mandating a full return to the office. Office expenses are still elevated, so companies are saying we need employees to come back to the office. And there's been a lot of headlines around that, but what we've seen is this rate has stabilized of around 30% over the past couple of years. So we believe that this is going to be a more permanent thing, despite headlines of employers calling employees to come back to the office. There's a lot of hybrid work arrangements, and 30% means that people are staying at home more, they're working from home more, they're also much more inclined to invest in their homes because they're using it for an office as well as for living. We've talked a little bit in the past about the undersupply of housing, and our thesis is we think the U.S. needs 1.86 million new homes for both for sale and for rent per year through 2033, just based on underlying demographics and current undersupply. And so we believe between 2023 and 2033, there's going to be 13.7 million households formed. This comes from larger millennial and Gen Z generations forming households that are getting into the prime homeownership age, where they're moving out and starting to forming their own households. We also think there's about 2.3 million homes that are just not able to be renovated anymore. They need to be torn down. So those homes are going to come out of the supply. They just won't exist, and there's going to be something that's going to be needed to replace them. People don't think about second homes too much, but we also think there's a demand for about 500,000 second homes. So think vacation homes, weekend homes. That still does affect the overall housing market, where one household may occupy two homes. We think there's a deficit of about 500,000 that's also needed. And we believe, as we're sitting here today, that we're undersupplied in the U.S. by about 2.1 million homes. I know there's a lot of talk around this number. I've seen numbers as high as 5 million. I've seen numbers as low as 1 million. But I think what everybody can agree on is there is an undersupply of homes in the U.S. right now. And we see the housing undersupply by 2.1 million units, and we estimate that to be about 700,000 for sale and 1.4 million for rent. So homes that are for sale, that are ready for sale, and then also rental homes. These are also apartments and multifamily units. The supply-demand imbalance did get worse in 2023 just due to the household formations, as well as the immigration number that I touched on earlier. They also need a place to live, right? We do expect some relief from more for rent supply from 2024, really due to the increase in multifamily unit deliveries that we're expecting this year, based on the multifamily units under construction, which is also based on permit data that we saw from 2021 and 2022. This is going to help chip away at that undersupply, especially on the rental side. But just given the magnitude of this deficit, we think that that there's still a long way to go to get back to a supply and demand balance. So now I'm going to talk a little bit about the insights from our latest window and door market survey. And Lori gave a nice background on it, but this is an exclusive partnership with Window and Door Magazine and John Burns Research and Consulting. It is a quarterly survey of residential manufacturers, glass shops, glazers, and installers. We ask things like volumes, revenue, lead times, backlog, supply chain, and guidance. And we use qualitative data. So what people actually say in comments, we ask, why are you thinking this? What is driving your response? So we get a lot of great qualitative commentary, and we measure that up against the quantitative data where people actually say, no, my revenue was up this or down this, volumes were up this, down this. So it's a measurement of qualitative and quantitative commentary to get to the overall sentiment of the industry. I talked last time about this survey and who takes part in it. And I will have a link at the end, a QR code to sign up if you'd like to participate in the next quarterly survey. One thing that I do want to stress is we guarantee anonymity and confidentiality. So when you respond to these questions, you can be assured of the complete anonymity and confidentiality. Your results are never able to be tied back to you or your organization. When we get the results, they come in anonymously, so we can't say so-and-so said this, so-and-so said that. There is absolutely no way to do this. So we feel that this gets to really great results because that confidentiality is ensured and that we know that there's no tie back. So this really affects the quality of the responses that we're getting, and also what gives us confidence in the responses that we think that they're true and accurate. That's why we say this is the first of its kind survey in the window and door industry. Obviously, this industry is largely privately held. A lot of companies don't want to give out this information. So this, I can't really stress enough the confidentiality and anonymity that we do guarantee in this survey. So there's 4 key takeaways for 2024, and the way we word it is we're framed for growth, pun intended, I guess, for 2024. The first one is companies are gearing up for growth. So there seems to be a sentiment that we've reached the bottom in the fourth quarter and things are going to start to turn around in 2024. A lot of sentiment around this is probably going to be, especially on the R&R side, more towards the back half. So when interest rates do come down and homeowners are more receptive to undertaking these large remodeling projects, which includes a full window replacement. We're seeing reduced backlogs, really driven by improved supply chain performance, as well as softer demand. So respondents said they were finally able to catch up, work through their backlogs, eat through them last year. And now backlogs are improved and supply chain is getting better too. Still seeing persistent material and labor inflation. Labor challenges are still an issue, and there still is a little bit of raw material inflation. And then finally, planned price increases for 2024. So let's dig into these topics. 56% of respondents reported year-over-year volumes declining in the fourth quarter of 2023, but total average volumes were flat year-over-year. This is important context. This really doesn't surprise us that 56% said volumes were lower in the fourth quarter, because in the fourth quarter of 2022, as you remember, companies were still working through these backlogs. Backlogs, by and large, for the industry, really didn't get worked through till early 2023 because there was such a significant backlog throughout in the COVID boom years, if you will. So volumes being down this quarter is really no surprise. What was a little bit surprising is 50% said companies reported revenue growing in the fourth quarter, and average revenue increased by 3.8%. This is really driven by price increases in late 2022 that are being lapped in the fourth quarter of 2023. The significant price increases that happened in 2022 and the backlogs, these extended backlogs where these prices were not able to be realized until into 2023. This is what drove revenue up despite weaker volumes. When we asked this question in the third quarter, what they predicted their revenue to be, our third quarter survey predicted revenues to grow by 2.9%. So the industry did anticipate this revenue growth coming, and it actually came in a little bit stronger than predicted. Thinking about inflation, we asked what the average inflation, year-over-year inflation is for raw materials and supplies and direct labor, and we see 4% year-over-year cost inflation in materials. That's consistent with what we saw in the third quarter. And companies are still reporting direct labor inflation up 7%. When we asked this question in the third quarter, respondents came back and said costs were up 20% year over year. That's really high. But context is also important because 7% is also still really high too. 7% labor inflation year over year is significantly higher. And so this is an indication that the labor market is still very tight and companies are having to pay more to maintain their workforce. 63% of companies reported reduced backlogs in the fourth quarter versus 25% reported increasing backlogs. The number of companies reporting smaller backlogs were higher this quarter, so these backlogs are continuing to be worked through. We saw commentary around eating through backlogs ready to meet market demand this year, but still 25% reporting backlogs increasing kind of stands out too. In some of the qualitative commentary, we heard mention of destocking of stock windows that took place at distribution in the fourth quarter of 2022, and now that destocking has been lapped and new orders are coming in. So this is actually what's leading to increasing backlogs in the fourth quarter of this year versus destocking the year prior. When we ask about what products or materials have extended lead time, so the supplies that go into windows and doors, 25% of them said that they're reporting extended lead times for insulated glass. The second line on here is not applicable. That means that everything's great, that we have no extended lead times for the raw materials that go into our products. And in the third quarter, 29%, the largest portion, said that it's not applicable. Everything was great. This quarter, 25% are starting to see some shortages and delays in IGUs. One thing that we've been noticing too, it did pop in our survey, we're monitoring it really closely, is issues around shipping, especially from Asia. Cargo ships are having to be rerouted around the Cape of Good Hope around Africa due to conflicts in the Suez Canal. So the Houthi rebels shooting down cargo ships in the Red Sea, leading through the Suez Canal. So we're starting to see issues around container availability, also raw materials coming from Asia. Companies seem to be able to be on top of it right now, but this is starting to this is driving up cargo shipping rates and also affecting container availability due to time in transit. So on average, shipments from Asia that have to go around Africa versus the Suez Canal, that takes about a week longer and certainly burns a lot more fuel, so the shipping costs are higher too. So we're going to be keeping our eye on that. That did pop up in some of the qualitative commentary. And so as you're thinking about how to plan your supply chain this year and not getting into situations that we had in 2020, 2021, 22, that's certainly something to keep on the radar and be thinking about as you think about where your supplies are coming from. 44% of companies reported project cycle times improving in the fourth quarter of 2023 versus 2022. Really no surprise, backlogs being worked through, softer demand. But in the third quarter, nobody responded that said it's taking more time to complete. And this quarter, the fourth quarter, 6% said that projects are taking longer to complete. Cycle times are getting a little bit longer. This is likely due to the supply issues that we're starting to see that I showed on the previous page. Looking into the first quarter, so their expectations of first quarter versus the fourth quarter, 44% of companies expect lower revenue. And we think that's typical seasonality driver. So, obviously in the winter months, there's not a whole lot of window replacements that are done in the cold winter months, especially up north, due to typical seasonality. One thing to note too is this fall was especially warm, so even into late December in many parts of the country. So these exterior replacement projects, they were able to continue a little bit later into the season. And then January hit and it was like a flip of a switch, and we saw a lot of cold weather. We had blizzards, a lot of snow. So the sentiment, we think, for the first quarter, as things were better in the fourth quarter due to warmer weather, things got really cold in January. And so that's the expectation of why they're expecting lower revenue this year on average in the first quarter on average by 2.7%. We're also lapping price increases from late 2022, and these price increases will not be as impactful yet this quarter. We'll see how this plays out next month when we start asking about the actual numbers, but they did predict the revenue growth in the fourth quarter in the third quarter survey, so we'll see if how true these numbers hold up when we release our next survey. 61% of companies said they're expecting to raise prices in 2024. In the third quarter, only 44% said that they were contemplating price increases. And so this quarter, the overwhelming majority says that either planning to or have already implemented price increases. Pre-COVID, as many of you know, the industry standard was the annual price increase of around 3 to 5%. Last year, many companies hit pause on price increases just due to the magnitude that came through 2022. Now we're starting to see a return to these annual price increases. And we think this is relevant because we're also starting to see this in our survey of building materials dealers. So we ask building materials dealers each month by product categories, how much price are you expecting to come through this year? And they're reporting for full year 2024, they're expecting full year price increases of just over 4% for windows and doors. So this is another data point validating these assumptions. And we'll be watching this to see, market acceptance of this and what the actual street price turns out to be. 60% of companies are not planning on making changes to their production workforce this year. 20% said they're planning on reducing production workforce or eliminating lines. Another 20% said they're going to add to production workforce or add lines. We talked about labor inflation. We talked about the difficulty finding labor that I know many of you are still feeling the effects of that. Understanding that we're coming off a period of extended backlogs and labor shortages is still fresh in the mind. So we see companies really trying to keep labor, hoard labor, if you will, for the expected demand increases that we're expecting to see later this year. A big aha for us this month was that 64% of companies are planning to add to sales and marketing resources in 2024. It's important to note that none are planning on reducing sales and marketing resources. There was a lot of qualitative commentary around this subject. There was a lot of the commentary was around, in the COVID boom years in 2020 to 2023, builders, dealers, contractors really kind of threw brand loyalty out the window, pun intended, but they were really focused on getting product. I just need product, and whoever has the lead times that can get me the product when I need it, I'm just going to take them. It's going to whatever I need to get the job done. So brand loyalty really waned. We're hearing a lot of instances of companies saying that they're going to refocus on brand building. There's brand loyalty. Orders are not just flooding in everywhere. There's a lot of work that needs to be done on lead gen, demand building, reestablishing company value propositions. So this was really surprising. 64% saying they're planning to add to sales and marketing resources, really having to relearn how to sell and how to generate leads, because the boom years are kind of past us now. So we'll be watching this really closely and see what companies are poised for success on that. Along that line, we asked what the main focus area. So what is the number one focus area for companies is, especially manufacturers, and we see 19% said production automation. So this is tying back to a couple different points. Number one, production automation due to the high cost of labor, backlogs, and trying to increase efficiencies in production. The other point, 19% saying really around design styles, deck glass or hardware, that's focusing on the company value proposition too. So how are my products going to be differentiated in the marketplace? And so really focusing on design. Another 16% say impact resistance, footprint expansion, energy efficiency, code changes, enhancements for easier installation. We saw some instances of that at IBS too. That was good to see, again, to shorten the install time on the job site. And then ADA, ease of operation. So production automation being the number one focus area, that is something to keep our eye out to. And we'll see how that impacts the direct labor costs as we move through the course of this survey through this year. This question get a lot of constructive feedback, and I'll put it that way. There's a lot of companies that say there will be no impact from the Inflation Reduction Act for a couple different reasons. Number one, the requirement of Energy Star 7.0, the barrier is too high. The cost for the windows associated with these requirements is too high, too costly for the homeowner. They're not willing to pay for it. And then the tax credits that come from that are too low to not really offset this. We think it will have an impact. We do think that it will have an impact as homeowners do become more aware of this. And so we included it here for a couple different reasons. Last quarter, none of the respondents thought that it would have any impact at all. And so now we're seeing 6% saying that they think it's going to be very impactful. We realize that the impact from this might be limited, but we're seeing it come up more and more. And we think this might be something to add to your toolbox when you think about product differentiation. The fact is homeowners are becoming aware of it, and it just may be one more part of the value proposition that you can extend to your customers. And then the final question was really around the company's plan on attending trade shows or conferences this year versus last year. 75% said they're planning on attending the same amount of trade shows and conferences in 2023 versus 2023. Another 25% say they're planning on attending more. We think this goes back to the topics of brand building, brand loyalty. We certainly saw significant presence from manufacturers and installers at IBS, and so we think that this is as companies are refocusing their efforts on brand building and getting their name out and showing their value proposition. This is going to be an important tool as we move through this year. And so now we're going to go into some takeaways, and then I think we'll have plenty of time for some Q&A afterwards. So wrapping it all up. Current economic conditions are favorable for new construction and R&R. The labor market is robust. Everybody says rate cuts are coming, and they will. And even yesterday, the Fed said that they are planning on they're penciling in 3 rate cuts this year. Consumer sentiment is rising, and that's certainly having a positive effect on consumer spending. Rate buydowns are continuing to keep the new construction engine humming. When we talk to builders, one of the questions we get the most is when are builders going to stop the rate buydowns? And what we're hearing from the builders is they're not. They're working. They're keeping new home sales up. That's leading to housing starts. And it's really, as we saw, the share of new home sales versus total sales continue to drive that upwards. Builders are continuing to take share. They're willing to take a little bit of a margin hit on these rate buydowns just to keep the engine humming, and we expect that to continue. The R&R market is showing signs of life, again, fueled by aging homes, work from home, and unprecedented wealth that we talked about. So homes aren't getting any younger. Work from home is still going to remain at elevated levels. Wealth is continuing to rise. We see continued home price appreciation, even in the existing home sales numbers that were released this morning. Existing home values are continuing to rise, so we're not seeing deflation in home values. And we expect these factors to continue to drive growth through 2033, just due to that chronic undersupply of homes. So the household formations that will be happening, the immigration wave that we're expecting to continue, at least near term, we expect these factors to continue to drive growth in housing through 2033 for both new construction and R&R. And so we see that the window and door industry is framed to capture this growth. I put a tagline in here. Kylie from our team pointed out that this rhymes. I didn't intend for that to happen, but the industry is catching a breather after a COVID-induced fever. So a lot of, and we saw this in other surveys that we do too, where we expected, oh, demand's down, we're expecting sentiment to fall. We're seeing more of a sigh of relief. Companies are saying, you know what, we're able to catch up. We work through our backlogs. We're able to focus more on what we need to be doing, more strategic planning versus just getting product out the door, getting projects completed. Volumes and revenues are normalizing, but there is broad expectation for a turnaround in 2024. Again, due to the factors that we talked about, new home construction, improving interest rates to drive R&R demand, demographics, the wealth effect. Inflation is persisting, and we are seeing early rumblings of extended lead times just due to supply issues that we're starting to see. We'll be monitoring that as we move through this year. But overall, inflation is still high, and that's why there's a focus on product automation and really controlling costs. And we're seeing companies really invest in demand generation and production efficiencies to really capture and satisfy this growth. So expected growth to continue. Companies are being a lot more strategic in how they're investing in demand generation, product development, production efficiencies to be able to serve the industry. And what we think is the main takeaway here is the industry is really relearning how to strategically plan production, plan demand generation, sell, get products out there, really focus on the value proposition and selling the product, really relearning that, and then focusing on efficiencies to capture this growth. So we think that it's kind of coming back to pre-COVID times where you have to strategically think about your business, think about where you want to grow, what makes sense, what products make sense, what product developments, and then focus on the efficiencies to really be able to economically capture this growth. So with that, we can open this up for Q&A. If you would like to participate in our next quarterly survey, this QR code on the right, you can scan that. That'll take you to a sign-up form that we have, and you can just enter in your information. And then we will anonymously send you a link when we send out the survey, likely next month, to ask about the first quarter 2024 results. And so we really appreciate it. We had really good participation this quarter. We had great participation in the third quarter as well. But obviously, the more the better. So anybody who's willing to participate, and it doesn't have to just be one person in the company does that. If there's things like, well, I know about my revenue, but I don't know about supply chain issues. We do see that a lot too. That companies will forward this on to colleagues in various other functions in their organization to fill out. So if you'd like to participate, again, anonymity and confidentiality is guaranteed. We'd love to have you. And so with that, I think we have plenty of time for some Q&A.
Thank you, Chris. That was a great presentation with a lot of information to digest. So moving into the Q&A, our first question asks about how the homeowner has shifted in their product need preferences. And the question also, and the person asking the question also goes on to say, I would expect energy efficiency to be a dominant factor historically, but as more people work from home or invest in their home, is this still a primary feature? Has there been a shift toward comfort, aesthetics, or other value features?
Yeah, that's a great question. So we actually have a survey that we do with our New Home Trends Institute, and it's part of our John Burns package. And the New Home Trends Institute does a lot of homeowner research, consumer research, and we also talk to architects. So we talk to production architects as well as with custom home architects too. And what we saw in our latest custom home survey is we explicitly asked, are you seeing more units, fewer units? And then are the openings larger or smaller? And what we saw overwhelmingly is there certainly aren't fewer units. There actually are more units going into a home, which is kind of contrary to what we're seeing from home sizes shrinking. So builders have been solving for affordability by bringing down home sizes. But we're seeing the overwhelming response was the same number of units, or in some instances more units. And then the openings are actually getting larger. So when tying that back to energy efficiency, there certainly is a concern for energy efficiency. It has been a #1 driver. What we're seeing right now is energy efficiency is kind of table stakes. Like I'm taking it for granted that new windows are going to be energy efficient. So it's kind of like table stakes. Like the product already has to be energy efficient because it just should. And we've been talking about this for years and years. And so now it shouldn't be a thing anymore. They should just be energy efficient. We're seeing a lot more around design aesthetics. Like I said, larger openings, the transformation of the indoor-outdoor world, so larger openings, bifold sliders, we're seeing a lot more of those being put into homes too. So it's really around home comfort. Noise is also a big factor too. So if you're working from home, you don't want to hear the kids outside screaming when you're on a conference call in the summer and the kids are home from summer break. So noise protection is certainly an aspect too. And then when thinking back about the focus areas, the #2 focus area, tied with #1, if you will, was really around design aesthetics. So decorative glass, decorative hardware, new colors. So we think that there is kind of a shift from the windows already need to be energy efficient. They should be, just because that's how things are. And now we're moving more towards the design aesthetic piece of it.
Absolutely. Speaking of design, I know IBS was only 3 weeks ago. Were there any big top-level takeaways that you took from there, or particularly notable trends in the space?
I'm thinking about notable trends. So definitely bigger, I would say, just in general. So bigger openings, bigger units, bigger, and this is doors as well as windows too. I would say in general, but particularly for the window and door space too, and this was kind of reflected in our survey, and it's been reflected in all of our surveys that we've been doing in our firm, is optimism. So just like, we kind of have reached this bottom. And I was talking to some fellow industry analysts that from outside the firm and kind of comparing notes and said, like, what was your overall theme? And the theme was like, we made it. The downturn wasn't as bad as we feared, starting to see a recovery. You know, certainly we're seeing that in consumer sentiment. We're seeing that in what remodelers are saying. We're seeing that what builders are saying. I think the only ones that are probably not too optimistic right now are realtors, especially with the new regulation agreement that was agreed to. But general thinking is, you know, it may not be reflected in sales yet, and that's kind of the thing. It's like where I'm like, okay, I'm not ready to say like we made it. It's just uphill from here. It's all up from here. I think it will be. I think it's going to be a very strong year. I think it's going to be more weighted towards the back half of 2024, really as people start to see these rates coming down and how that affects the psyche and affects like, okay, inflation is coming down. We're not at a deflationary period, which we don't want to have anyway, but there's disinflation. Things are getting more reasonable, or at least I've become accustomed to them. And then the headlines are on, well, interest rates are coming down. So we think that that's going to unlock more opportunities. But really, you know, like I said, design aesthetics piece of it, but then also just the optimism that 2024 is going to be a solid year for the industry.
Sure. One of our other questions says, hi, Chris, are you considering making a survey about the passive house greenhouse industry that might be the new leading building system for the coming years?
We have not. We've talked about that. We've talked about that a little bit, and that's a great input. So I'm going to write that down. I think that's something that we can be looking into, because I think obviously for this industry, it's very important. But you know, that trend, I think it's going to be the passive house. It's going to be limited for now in certain parts of the country. But it's like one of those things, demand for it's not going to get any smaller, right? So kind of like with modular construction and components, like we don't expect there to be less of that. We expect that to be more, even though the base might be relatively small. So that's a great idea. I think we'll jot that down and think about that.
Sure. Now, one of the things you mentioned was that companies are kind of refocusing on how to strategically sell, plan, and focus on efficiencies. Was there any commentary about how companies might be using technology or AI to help achieve some of these goals, especially in the face of the labor challenges?
That's something I think we're going to ask specifically around AI for next go round. So our client base is very broad in the fenestration industry, but also in other building products. And so we've been asking around about, you know, how much is AI being used? It's still early days. What we're hearing right now, we're seeing it a little bit in kind of the forecasting and taking trends and figuring out, you know, when is this demand going to hit. We ourselves as a firm, as we think about where demand is going to go and looking at regional variances, one of the things I didn't bring up here, but we actually unveiled it in the fall, is what we call the building products demand meter, where we're actually estimating the number of units, installed units. So this isn't shipments, this is actually installed volumes, and we do it across 18 different product categories, 2 of which are windows and doors. So we do that, and we've been using AI and machine learning to understand, you know, we have a data series going back to 2000, so over 20 years of data. And the good thing about that is we went through obviously the GFC through then, and we went through the COVID boom then. So we're putting that modeling into machine learning to really help understand what we think volume demands are going to be for this year and then 2 years into the future. And we publish that for these 18 different product categories on a quarterly basis. We update them each quarter. And we also break it down by quarter. So Q1, Q2, Q3, Q4 for 24, 25, 26. So we're hearing from a manufacturing standpoint, we're seeing some instances really on the FP&A side. So the planning of, you know, what do they think sales are going to be? I have not honestly seen too many instances of it in production. I would love to get examples. So if you're on this call or you're listening in a later date and you have some instances, I would love to learn more about that and understand how your organization is doing that. We get asked about that, like, are you seeing this? And the short answer is, yeah, on the FP&A side, we are. Not so much on the production side yet. But again, you know, we don't think it's going to get less. We think that that's only going to grow.
Thank you very much, Chris and Lori. If you have additional questions, obviously feel free to reach out to both of them directly. We do hope you'll take a minute to consider completing and participating in the survey for next quarter. If you scroll up further in the chat, there were 2 additional surveys you could also consider. A recording of this webinar will be made available on glass.org/webinars tomorrow. You should also receive an email to prompt you to visit that site and also complete a brief survey for us. We'd really appreciate it. In the meantime, please mark April 18th, the third Thursday in April, for our next Thirsty Thursday, and we wish you a lovely afternoon.